Let's look at the financial statement assertions. And this is the last part in topic 3 auditing. So, financial statement assertions are representations. The definition: financial statement assertions are representations by management embodied in financial statements, like representations by management put in financial statements that are used by the auditor to consider the different types of misstatements that may occur. So these are, let me say, items that are put in the financial statements that the auditor uses to consider the different types of misstatements that may occur. Assertions relate to classes of transactions and events, and then related disclosures, and also account balances at the end of the period and related disclosures. So we are going to have two types of assertions. Assertions that relate to classes of transactions, events, and related disclosures. Those are items that are represented in the statement of profit or loss and other comprehensive income. Then we shall have assertions that relate to account balances and related disclosures, those that are represented in the statement of financial position or balance sheet. So audit tests are designed to obtain evidence about the financial statement assertions. So ISA 315 requires the auditor to use assertions for classes of transactions and related disclosures, into brackets, those in the statement of profit or loss, and account balances and related disclosures in the statement of financial position, in the assessment of risks of material misstatements, and then the design and performance of further audit procedures. So the auditor is supposed to use these assertions when assessing the risks of material misstatements and when designing and performing further audit procedures. So according to ISA 315, it lists two types of assertions. So we are going to start with the first one, which is assertions about classes of transactions. I repeat, like, classes of transactions are those transactions that appear in the statement of profit or loss. So we shall look at the sales, the purchases, the inventory, we shall look at the expenses and all that. So we shall start with the assertions about classes of transactions and events and related disclosures for the period under audit. So the first assertion under classes of transactions is occurrency. So the auditor has to make sure that the transactions and events that have been recorded or disclosed real occurred, and such transactions and events pertain to the entity. Like in case sales were recorded, the auditor has to make sure that those sales occurred. In case purchases were recorded, the auditor has to make sure that that transaction took place. So occurrency is the first assertion. The second assertion is completeness. So here the auditor has to make sure that all transactions and events that should have been recorded have been recorded, and all disclosures that should have been included in financial statements have been included. So he has to make sure that the information that was recorded in the statement of profit or loss is complete, like they did not miss out on anything. Then another assertion is accuracy. Here the auditor has to make sure that the amounts and other data relating to the recorded transactions and events have been recorded appropriately, and related disclosures have appropriately been measured and described. Like, has to make sure that what was recorded in the financial statements is actually correct. And this can be done by maybe like recalculating, maybe he or she recalculates the sales and see if the figure that was recorded is accurate. Then another assertion we have is cutoff. The auditor has to make sure that transactions and events are being recorded in the correct accounting period. Like if something was supposed to be recorded in this period, it is recorded in this particular period, not in the next period, or it wasn't recorded in the previous period. So the auditor has to make sure that transactions are being recorded in the correct accounting period. Then another section is classification. Here the auditor has to make sure that transactions and events are being recorded in their proper account. Like if something is supposed to be under sales, it's there. If something is supposed to be under cost of sales, it's there. That's classification. The last assertion for classes of transactions is presentation. So here the auditor has to make sure that transactions and events are properly aggregated, like added up or disaggregated, in case they're supposed to be subtracted, and clearly described, and related disclosures are relevant and understandable in the context of the requirement of the applicable financial reporting framework. Like let me say for cost of sales, you get opening stock, you add purchases, you less inventory, you get cost of sales. Then you get sales less cost of sales, get gross profit. So that is presentation. So the auditor has to make sure that everything is presented well, like whatever was supposed to be subtracted was subtracted, whatever was supposed to be added was added. So let's look at the assertions about account balances and related disclosures at the period end. These assertions related to items that appear in the statement of financial position or balance sheet. So the first one is existency. The auditor has to confirm if the assets that were recorded in the financial position, like real, exist, the liabilities also exist, and the equity interests and all that. Then secondly is rates and obligations. Like the auditor has to confirm if the entity real has control over the assets, or it has rights to the assets that were recorded in the financial statements or not. And then they have to confirm if the entity real has the obligation to the liabilities, to pay the liabilities that were recorded in the statement of financial position. Then another section is completeness. So here the auditor has to confirm that all the assets, liabilities, and equity interests that should have been recorded, and all related disclosures that should have been included in the financial statements have been included. So here it's confirming like everything that was supposed to be there is there. That is completeness. Then another one is accuracy, valuation, and allocation. So for account balances, the theory. For classes or transactions, it's just accuracy. But for account balances, it's accuracy, valuation, and allocation. So here the auditor has to confirm that assets, liabilities, and equity interests have been included in financial statements at appropriate amounts, and then resulting valuation or allocation adjustments have been appropriately recorded. Remember, like assets depreciate. So the auditor has to make sure that depreciation has been recorded at the right amount, then plus the net book value and all that. So accuracy, valuation, and allocation. Another assertion is classification. So here the auditor has to confirm that assets, liabilities, and equity have been recorded in their proper accounts. And lastly is presentation. The auditor has to confirm if assets, liabilities, and equity interests are appropriately aggregated. Remember, we are supposed to get the total current assets, then the total non-current assets, then we add them to get the total assets, then we add equity and liabilities, like that. So the auditor has to make sure that they are properly aggregated or disaggregated and clearly described, and related disclosures are relevant and understandable. Yeah, so those are the assertions in relation to account balances: presentation, classification, accuracy, valuation, and allocation, then existency, rights and obligations, and completeness. That is all about assertions, and this is the end of topic 3, auditing. Thanks for watching. Do not forget to subscribe, like, comment. Let's catch up in the next video. We shall be introducing topic 4, which is internal control.